was, hey,
Sorry about
we
that.
don't we don't pay for cable, so why do we need to, have a contract? But anytime somebody's on your personal property, there's an opportunity. You're granting them access, and so
Mhm.
we evolved, and now we represent owners, and we have affiliates that can help with more than just cable and internet. We can help with electric and gas in some cases, water, waste removal. So we've evolved into multifamily utility solutions.
That's great. And the reason I want to have you on is because in the real estate space, when you're managing these properties and owning these properties, a lot of people think, oh my gosh, you must make millions on them. But actually, the margins are pretty tight, especially in North Jersey here where we buy. And, making a difference on a few $100s or a few $1,000s a month can really add up on these properties. So even when you're talking, we're buying a $10 million property right now, but at the end of the day, boy, if I can increase the rent roll or the income on the property by another $500 a month, that actually makes a big difference, because now also the property is worth more money because I'm increasing the net operating income. And the way that commercial real estate is evaluated, it's a multiplication of the net operating income. It's the cap rate divided into the net operating income. So it means that the more I get the income up on the property, it's an exponential growth in property value. So $500 a month or something like that extra coming in might sound like a small amount, but actually if you add it in with the income of the property, now all of a sudden it boosts your property value a little bit higher as well. And it just, that's straight profit also. So what we're talking about today is straight profit. It's not like, an additional investment. These are things your tenants are already paying for, but it does only work for larger buildings. So I'm going to break into the questions here. Kevin, I have about 6 questions for you, and you have about 6 questions for me. And we're going to talk about going on here. All right. So let me just go over our questions here. All right. So I'm going to start with your question. The first one here is, what's the difference between a bulk contract where the owner provides a service, internet or TV, as an amenity, and one where residents pay their own service?
Yeah, I mean, it really is. So there's 2 types of agreements. One is just simple access. Let's say I'm the cable company and I want to be on your property, Aaron. You are just simply granting me access. Now, there may be some like exclusive marketing rights or things like that associated with it. But you're giving me the opportunity to be on there, and then your residents are paying for that service. So you're not on the hook for anything other than maybe helping me with marketing, right? You aren't paying anything.
Yeah.
The bulk contract is when just like it says, you buy in bulk. You pay for service and really provide it as an amenity. And so really the difference is, do you want to invest in that as an amenity, right? Let's say you didn't have a workout facility on your property. Would you want to invest and build a workout facility on your property because you valued that as an amenity, and more importantly, your residents valued that as an amenity? Well, the same thing holds true with cable and or internet. Do you want, in your situation, does it make sense? Will you make money by doing that? Will you attract more people? Will you be able to raise your rent and more than cover the cost of that amenity? So you are investing in your property, similar to what you would with a workout facility or anything like that.
Interesting. Okay, good stuff. Good stuff. Okay, let's move on to your second question here. And so, if residents pay, why do I need a contract?
Yeah, well, I mean, we touched on that because it's your personal property, right? I mean, so if you are, you're allowing somebody to come, excuse me, on your property. So you mentioned, Jersey, right? So Comcast is big there. Let's say you have a home in New Jersey. Comcast is given the right to be on the public easements by the city, but that doesn't allow them to be on anybody's personal property. If you're a homeowner and you want to sign up for their service, well, guess what? You can sign up for their service and you're allowing them to be on your personal property as the homeowner. But in the multifamily space, there's an extra step in the process. There's a gatekeeper. If I'm a resident in your, in your community, and I want Comcast, but Comcast doesn't have the right from you, the property owner, to be on the property, I can't grant that to them. So there's an extra step in the process, and with that extra step comes value, right? And so you said, no, I don't want them here, right? Well, in that case, then I couldn't get it service. So there's value there. So that's how that works.
Okay, interesting. Okay, all right. All right, and how many units does the property need to be for this to make financial sense here?
That's a judgment call by both the owner and the provider. I just this week had a 40-unit property, which is normally below the threshold, and we were able to get them compensation, which is not all that common with 40 units. Wow. And they said, well, it's not enough to really worry about. So in their mind, it wasn't enough to worry about. Quite frankly, I thought it was a pretty good, we got $100 a door plus ongoing revenue share. So, to your point, every dollar helps. But they didn't want to. So, that's their right. That's their, 100 is a sweet spot. If you've got 100 units, I know we can do something for you. In most cases, it does depend on where the location is, right? It depends on who the providers are, because some providers are more willing to do this. They may be in a more competitive marketplace and things like that. If you're out in a rural area where you have there's only one provider out there, they may not be as willing to do an agreement that has compensation. If you're in a, more of an urban market with competition, they may be more likely there. So 100 is the sweet spot, but it does depend on, on the other locations. I mean, we've done as few as 12, but oftentimes those are bundled with other properties. And again, it depends on who the provider is. My policy is 12 or more, I'll ask, right? What's the harm? You can't, the worst they could say is, no, we wouldn't do anything. But they may surprise us like they did on that 40, because it's not a market that they normally do any compensation. But they wanted this property specifically for some reason. And we were able to get what I thought was a pretty good offer.
So, and just to clarify, in that case, so it's like a Wi-Fi company, or basically a company that provides internet, right? And cable and telephone, all that fun stuff. And they're saying they're going to pay you $100 to pay the landlord $100 a door to have what exclusive rights to the building.
Yeah, exclusive marketing, which simply means that if you're the owner, anything you can control from a marketing standpoint, you exclusively promote them. You promote them as your preferred provider, right? You can't control whether another provider sends direct mail or, anything like that, but you can control who is highlighted. If you have a point of purchase display in your office, if you hand something out that says, hey, here's our preferred provider, those things you can control. So to the extent you could control it, those are things that, you would do exclusively for them. And that's what the compensation is for.
Okay. And that's a one-time payout to the landlord. Is that how that works?
That is, but then there's ongoing revenue share as well, which is just a flat rate that basically says, we'll give you a percentage. Now, a lot of people get worried about that. Well, how's that's going to negatively impact my residents, right? Because how are they just giving? But it doesn't. It doesn't. By law, they have a rate card for a community. And whatever that rate card is, they cannot charge more than that. So they can't assess a fee. So you're not, when you do an exclusive marketing agreement, it is transparent to your residents. Your residents aren't losing out in any way. You're not eliminating choices.
Right.
You're not giving them the exclusive right to provide service. You're giving them just exclusive marketing rights. So other providers that are already there can still be there. You're not kicking anybody out. Your residents aren't being charged more or anything like that. So really, a lot of people say, well, why wouldn't I do it? And that's usually what we say is, right, why wouldn't you do it?
Yeah, I mean, something that your residents are paying for anyway. They're not going to be paying more for it if you're working with a company. In fact, a lot of times they offer like a promotional price to your tenants, because you're
Yep.
teaming up with them. So yeah, I agree. I think it's an interesting thing to take advantage of, because otherwise the money's just going right to the cable company, or the internet company. So in that case, you're getting a small piece of the action, and that's really, what it's all about when you're running buildings of large scale like that. Even if it's a small revenue share, actually the payment up front, that's not bad. So that's like $4,000 lump sum payout in that 40 unit example, right? If you have 40 units,
Yep.
you're getting $100 a unit. To basically put a flyer in your welcome package, and maybe have a postcard at the front desk, or something like that.
Yep.
You're not really inconveniencing your staff all that much. Now, are you knocking on doors and selling the product? You're not, right?
You are not. No, you may allow them to have a representative go through there if that's acceptable to you, but you are not doing that. No, you're not doing that. And there's several different providers, right? There's the Comcast and the Charters of the world, who are traditionally referred to as cable companies, even though through the evolution of technology, they're really broadband companies, and their number one service is internet service, right? But they still offer cable TV, they offer phone service, they offer home security in some cases. And then there's the traditional phone companies, which have always been referred to as phone companies, the AT&Ts of the world, the Verizons, the Frontiers, and folks like that. And they both compete with each other in communities. There's also independent folks that will rent or lease dark fiber that happens to be going, and they'll come in and they can provide additional services as well. So there's really options, and it just comes down to the first thing we do is when we talk to a new client is, let's find out what your goals are. What are your goals? I mean, are you going to buy this and create generational wealth? Are you getting in and getting out and paying back your investors? I mean, those may dictate what the right solution for you is, because the right solution is very different. Depends on location as well, size of property. Do you have other properties in this community? So there's a lot of things, and we like to find all those things out before we make any recommendations whatsoever.
Okay, so for home landlords with multiple properties, maybe in a city or close proximity to each other, they say, well, listen, I don't have a 100-unit property. I don't even have a 40-unit, but I have a 6, I have a 12, I got a bunch of 2s, a handful of 3s. That's really how most people start investing in real estate. It's not logical to necessarily go out and buy 100 units. So in that case, you're saying if they're close enough and you have enough units kind of in a city or a collection of cities, that the cable companies will possibly work with you on doing this payout and some long-term incentive.
Provided, so the 2s, the 3s, those are treated as residential. Those really are nothing that we can do anything with. So I mentioned 12. The real minimum is more like a 20. I mean, the 12 works if you've got 100, a 50, and an 80. Then the 12 works. But if you've got like 3 12s, that's not really gonna be of interest to them. So, but yeah, I mean, the worst. My policy is ask, right?
Yeah.
Just let us ask, let us find out.
Yeah. Well, we have about 150 units all throughout North Jersey. And a lot of them are 25s, 27 units, 11 here, 6 there, So definitely over the years have built up good portfolio. I guess you'd have to look at a portfolio like that and then kind of decide if it's a good fit for your service here, right?
Yeah, it depends on who the providers are in the area. It also depends on what other clients we have in that area, because we can generate leverage through multiple clients in a given market, right? So if we've got others in there, we've done this very well in Dallas, Texas. I mean, we've got half a dozen clients down there. We've got a large number of units that we represent in that marketplace. Nice. So we get kind of more favorable looks because we have that number of clients and that number of units.
Very interesting. Okay, excellent stuff here. All right, let's move on to your next question here. So how much can I expect to receive? That's a pretty good question there. How much would landlord expect to receive in this scenario?
Well, I mean, we already kind of touched on it a little bit. The door fee is one thing, and this is for non-bulk. The door fee is one thing, and that can vary anywhere from $50 up to a couple hundred, depends on where, who the providers are, how competitive it is. And then you get ongoing revenue share. And the average that we see, I mean, it's a big range, but the average that we see is about $25 a unit per year. It's paid out quarterly, but it's about $25 a unit per year. That's not a paying unit. That's not a occupied units. That's just number of units. That's the easiest way for us to calculate it. So if you've got a 100-unit property, you're probably going to get about $2,500 in revenue share per year, which, I mean, it adds up. One of the best lessons, one of the best advice I ever got was from the CFO at Comcast, who used to always say, "Look, guys, $1 million is $1 million $1 bills, right?" So this was years ago, so it might the math may have it may have changed. He may be talking about billions these days, but that was it. And so the lesson really was, take care of all those things, because like you discussed earlier, Aaron, with a cap rate and all that kind of stuff. Last year, we generated about $4 million for our clients in improvement to net operating income. So you take a conservative cap rate and apply that, and think about that. That's probably what, $80 to $100 million in asset value.
No, you're right. Absolutely. Net, 2,500 to the bottom line. Also, right, there's no additional cost to get this. It's ongoing revenue. It's consistent. So, yeah, I mean, I was thinking to myself, okay, $2,500. Depending on the building, that might be 1 or 2 months rent. But think about it, you have to buy an apartment to get that rent. You have to renovate it. You have to pay insurance and taxes and so mortgage. So, with this, you're literally it's icing on the cake. It's more income coming in. It's not going to make you rich, but it's going to allow the property value, like we were saying. I mean, if you're at a 5 cap, I mean, I could do it right now on my phone. I'm curious, how's the calculation go here? So we're at a 0.05 cap. Was it divided by $2,500, right? So, or has it not? That's the other way around. Sorry, 100 divided by 0.05. Let's see, $50,000 right there. So if my building makes another $2,500 in net operating income, net profit at the end of the year, and I'm estimating it on a 5% capitalization rate, which is where a lot of property where I buy, that's where the cap rate is in North Jersey here. A lot of places it's lower than that. That's going to add $50,000 in property value. So when I go to sell that property, I'm going to say to the buyer, listen, buddy, I have a contract with Verizon here, and they pay me $2,500 a month. And so that's going to go right into the numbers. And there's no expense to knock that out. There's no salesperson I have to pay, or taxes, or insurance, or additional real estate I have to buy. That's straight to my bottom line. And that might be the cost of my landscaping through the year, right? So you look at it like that. It's like you're getting free, so that it's interesting. It doesn't sound like a lot, but $50,000, well, everyone knows that's a lot, so that's the magic of real estate. You increase your revenue here by $2,500 a year to the bottom line. You get a 5% cap rate. That's $50,000 in additional value you're creating in your building. And that's really where the money is in this strategy. The 2,500 is nice and all, but it's really going to be in the resale value, or just the value. You go to refinance, right? The appraiser says, well, how much money does the building make? Show them the numbers. That's going to be right in the numbers. There you go. So now your appraisal value, boom, $50,000 higher, right? So you can pull out another $30,000 in the appraisal. So definitely a very cool strategy there. Okay, excellent. Let's go to your next question here. At what point in the acquisition process do we need to start?
It's never too early. Because sometimes it can be too late. Right. I had a pretty large client. They were looking at a building in Kentucky, 156 unit property. And they asked me, they said, well, we're looking at this, it's out there. What can you tell us about the cable contract? Because the current owner said, or agent said that, they didn't know that they had one. They didn't know. And we found out that they were currently negotiating for a new contract. And if they'd have signed that, the door fee would have went to them, but the revenue share would have went to the new owner. So we kind of said, hey, you may want to ask a few more questions, put a stop to this. And we saved them. That was a nice, like $30,000.
Wow, that's incredible.
So,
Okay.
we can find out, before you buy. Sometimes, depends on who it is and what's going on. But yeah, it's never too early to ask.
Okay, very good. Very
Especially
good.
since you don't pay us unless you get money, right? So
Right.
our business model is that we work 100% on commission, no retainers, no hourly, no anything like that, right? So we're working as your advocate. We're trying to give you information to make a good decision. And if you do a contract that we've helped you do, then you pay us after you get paid. So it doesn't hurt to have us asking these questions and trying to identify whether or not there's actually an opportunity there or not. That's our job, is to help you determine if there's an opportunity for you to make money.
Yeah, that's great. So that's really interesting. So you're strictly commission based, and so the property owner doesn't have to go out of pocket to hire your services. That's really nice. Okay.
Yep.
No, that's good to know. All right, let's go to your last question here. So how did the recent FCC ruling impact the process?
Yeah, so everybody panicked at first, right? The FCC comes out and says you can't do this, you can't do that, and all that. All they want is to make sure that nobody is left out, that residents have options and have choices. So one of the big things is that you cannot do an exclusive agreement that says you're the exclusive provider. You can't do. And what they used to do is what was called graduated revenue share scale, so that you would be, as the owner, incented to only get payments from one provider because you got more as they got more customers. Now the model is just flat rate. You get the same whether you get 4%, whatever the number is, whether they have one customer or whether they have 100 customers.
Okay.
You're still going to get the same flat percentage. Before, it might have been you only get 2% if you have one customer, but at 100 customers you get 8 or 9. So you were really then, trying to not, and you may not have given the other people even a contract. Now you can have a contracts with multiple vendors and flat rates. So it's pro consumer. It's understandable. Door fees still exist. Revenue share still exists. Bulk rates still exist. There's really it's just that you can't put too much emphasis and favorability on one to eliminate choice for your residents.
Sure. Okay. All right. Very interesting. Very interesting. So, okay, so you can still run your business, still make the overrides. It sounds like you can have multiple options then. If you own, big enough building and it made sense, you could have a couple different contracts with a couple different major companies and offer your tenants plenty of choices there. And, it doesn't really matter who they choose. You're still getting a piece of the action, so that's really a nice structure at the end of the day.
Yeah.
That's good. All right. Excellent, Kevin. Well, that's all the questions I had for you. So I know you have a few questions for me as well. If you want to pull those up.
I do. Yeah, absolutely. So you already touched on this a little bit, but I'm curious if you can give me some more details. So with interest rates increasing, right? I mean, is real estate still a smart investment?
That's a good one. And people are asking me that today for sure, all the time, as we're buying a $10 million building right now. So yes, I think real estate is still a smart investment if you buy it the right way. And we always buy it this way. It's value add real estate, right? We look for buildings that we can increase the revenue on the building through renovations and improved management of it, lowering our expenses, finding out more ways to make different forms of income on the property, which is exactly what this is. But you can also make more forms of income on a property, from charging for parking or storage or late fees or different move-in rates and different ways, pet fees, have amenities in the building. Sometimes you charge for those, so for example, we're buying a building right now Rents are 25% below market value. It's in a good location in central Jersey. And, we're looking at about $1 million and about $1.1 million in renovations to the property overall. But over about a 3-year period, we're going to renegotiate leases, renovate units, release them for top dollar. The gym, for example, in the building has a his and hers locker room with 2 saunas on each side, and it's being used to store the construction material for the owner of the property. So just a perfect example of a wasted space that we could recreate very easily into a gym or even a common area to kind of hang out, and either charge additional for that or include it as an amenity, and and get more rent for the units. But at the end of the day, so we look at value add apartment buildings. We plan on leasing these units once they're renovated for what they're already leasing them for, what they're already leasing renovated units in the building for. We just plan on continuing that. If rent goes up, great. If inflation continues, great. We don't need that to happen. So when we underwrite a building, we assume inflation stops growing. We assume inflation goes to 1%. We assume cap rates go up by about 50 basis points to 100 basis points. We assume that interest rates go up as well. So we're assuming the market's going to kind of slow down a little bit in the future, and we can actually put that into our in-depth spreadsheet. We can paint a picture of what the market might look like. We could stress test the building. What if rates go up to 8? What if cap rates go up to 8? What if inflation drops to 1? What if inflation goes to 10, right? So all these things work to either bring your building value down or bring your building value up. Like inflation brings us up, but higher interest rates will bring us down. Higher cap rates bring our building value down. So we stress test it. We figure out what could happen in this macroeconomic environment, and then we make a conservative offer, and we do it with conservative terms. I have an interest rate straddle in my contract right now. That means if interest rates go up by a certain percentage, my price goes down. Now, also, if interest rates go down by a certain percentage, my price goes up, to be fair to the seller, right? So that's called an interest rate straddle. Now, me and you both are pretty confident interest rates in the next 90 days aren't going to go down. In fact, they're more likely to go up, of course. Right. So that straddle, of course, in my opinion, is working in my favor, considering the time period we're talking about is June to September here as we're closing on this asset. So the bottom line is you want to be conservative. You want to price out changes in the market that are coming up, negative changes, prices being not as high in the future, or at least not continuing to grow at this rate, right? Now, I personally feel like real estate actually is going to stay strong, and actually the demand is continuing to stay strong. I do see interest rates tapping down the market a little bit, but it's still, in North Jersey, it's a high demand market. And that's one of the reasons we buy in North Jersey as well, because we continue to hold that demand. Even if there is a recession, North Jersey historically has been one of the highest demand markets. So yes, we're going to see prices go up and prices go down over time. Interest rates go up and go down. Same with rent. But here in North Jersey, it's a nice hub of activity, consistent demand. And the bottom line is to be conservative when you're underwriting your property, and you won't overpay for it in this environment.
Aaron, you just answered 3 of the questions I had for you in one answer. Because I was going to ask you why Jersey, and I think you touched on that as well. And then I was going to ask you.
I could expand on all these. Let me expand on why Jersey real quick. So not, obviously we have New York City. Some people say the greatest city in the world. So we try to buy within generally an hour of that. We're also looking into Philadelphia right now, the city of brotherly love. So we see a lot of potential there. We bought Newark and Patterson and Jersey City for years. We continue to buy there. We've done very well. We made our first $1 million in downtown Newark. That area has really boomed. So it's been, a good market to invest in. We have the in-house management company here. We manage everything in-house. Right, so that does limit us to where we can buy as well. We want to buy within about an hour of our office so we can keep eyes on our property, make sure our independent contractors and our boots on the ground are all doing the right thing. So Jersey has this hub of population, so many people living in one place, high income, high education levels. The jobs here are excellent. They're high paying jobs. And people are, I get it, they're moving out of state. There's a net loss of population here, but there's just not enough housing. the housing prices, there's so much upward pressure on them.
Yeah.
They're not building enough housing. And here's the kind of good thing about housing, if you're a landlord, when we figure out, oh shoot, there's not enough housing in the state. It's not one of those commodities you can just like, all right, we're gonna, like food, like the baby shortage. I have an infant right now. It's scary going to the store and seeing no baby formula on the shelves. My wife doesn't breastfeed. We need formula. So it's a scary thing, but formula and food, they can kind of like ship in from elsewhere. So I think we're going to be okay. They're shipping it in, they're flying it in. Our parents are helping us out. You can still order online. So food is a commodity that you can kind of ship in, right? Housing, you can't really just like ship it in and stock the shelves. You got to build these things. You got to get permits. You got to buy the land. You got to get approval. The whole thing. You got to bring in the material, get the right builders, put all the pieces together. It takes about 3 years to develop real estate from start to finish in New Jersey.
Okay.
So because of that, it's a commodity that's going to continue to be, we're not even catching up with the demand. We're not building it fast enough. So I believe real estate in North Jersey will hold its demand with the amount of people living here that need a place to live. People are moving a little further from the city into West Jersey, Central Jersey. So we are focusing now on cities like Trenton, New Jersey. We like North Philly. We even like the Brunswicks. The building we're buying right now is in Trenton, New Jersey. We see a lot of opportunity there with high-end housing coming up and just more luxury apartments and things like that are getting leased up faster than they can even build them. So that answers your question about why Jersey. I like to talk.
So what I hear you saying is buy where you know.
Yeah, buy where you know, but I mean, I would also buy, I've bought real estate in rural markets. It's scary, no one really else is out there buying, I mean, now I bought rural markets during the pandemic in New England when it got super hot. So it was like the best time to buy and the best time to sell. I kind of bought at the beginning of the COVID and I sold like towards the end of the COVID. So New England properties shot up, but I've also owned real estate in southern rural Vermont, in 2018. And like, I kind of knew going in, like, I'm just buying this thing to come up here and ski. It's probably not going to really go up in value all that much, but it's, hey, instead of paying an arm and a leg to stay at the resort, I'm going to stay at this nice little home down the street. Okay. So, but so buying in a rural market is a scary proposition. You want to buy in high demand markets. There are emerging markets. I know like Cincinnati is like an emerging market. People are getting into, you have like the Carolinas and things like that. But I think you want to focus on the hubs, like Dallas, Texas, that's a hub. You want to be around that. Huge demand, huge population growth. You have New York City, you have Los Angeles. Now, I'm not saying buy in New York City. I'm not saying buy in Dallas, but we buy around these areas within generally an hour of the city. And that's been a great recipe for us. But generally buying Class A real estate in the city is not a good strategy, in my opinion. We buy Class B and Class C buildings about an hour from the city or less, and that's a nice recipe for success.
Okay. Well, what happens though if the value does drop? I mean, because you've got investors that have entrusted you with funds, and they're hoping for a return on that investment. What happens if the value of the property drops?
Sure. So first of all, we buy the property at a discounted price. So we have some equity right off the bat. Secondly, we're forcing value into it by raising the rents and increasing the value of the property by increasing the net operating income. So all that's pushing the value up on the property. But now there's macroeconomic pressures. Let's say there's a recession, and just like in 2008, there was a real estate collapse, which I don't think we're going to see again. That was a very different scenario than what we're seeing right now. But let's put ourselves in that scenario again, right? So there's a real estate collapse. Values drop by 30%. That was an anomaly that happened, once in 100 years there, but that can happen. We saw it happen. So in that scenario, that's exactly why I buy mismanaged apartment buildings. We're buying them for a good price. We have built-in equity. We're increasing the value, and they produce cash flow. So if the value of them drops below what we're into the property for, and the building's underwater, that's not a good thing. We don't want that. It's not going to help with our cash out refinancing. But at the end of the day, the building's still producing cash flow. It's still covering its costs. There's still a number of units being rented. And I understand in recession, tenants lose jobs, you have trouble collecting rent sometimes. But again, we focus on more high demand markets, areas where we're attracting a little better tenants. In North Jersey, you do have people earning high earners, strong white collar jobs, a lot of good high earners looking for housing here. So our problem is not leasing the buildings up, it's generally finding a good deal. But we don't really in that case, if property values completely dropped, we just wouldn't refinance at that time. We would wait for the market to cycle, wait for the market to come back. Real estate overall, especially commercial real estate, real apartment building, residential housing, is a good investment long term. It does tend to hold its value in recession, even in New Jersey here. Even in recession, we do see property generally holding value. Now, in 2008, 2009, that was a real estate recession, so we saw a lot of loss there. So we want to, in that case, batten down the hatches, keep collecting rent, keep covering our costs. We're not going to refinance in the bad market. We're going to get too low appraisal value, wait for the market to cycle back up, and then refinance, right?
So do you need to refinance? Because how does it work with your investors, right? So let's say I wanted to invest with you. Touch on that for me, because if you're not able to refinance, what impact does it have on investors? Do you, how can I invest with you, right? I mean, can I use my IRA? Is there a minimum? And then what's the period of time that I'm obligated for? And, if you get jammed up in one of these situations where you can't refinance, how does that impact your investors? So okay, that was like a bunch of questions,
yeah.
But
all right, so you definitely can invest with your IRA. About a third of our investors are self-directed IRA or solo 401k investors, so we welcome that. And listen, if the real estate market collapse, your stock portfolio is going to be a disaster as well, right? So we're talking about a scenario where you're really not going to get shelter much of anywhere. If apartment building values dropped, I mean, there'd be a ton of macroeconomic downward pressure, interest rates 9, 10, 11, something like that. I do see them staying strong here in North Jersey. Demand for rent is so strong. But, what happens is if property values really drop a lot, you are looking at essentially not refinancing at that time, right? So it would not be a good scenario. We'd have to just hold tight. We'd keep getting a little cash flow on the property, maybe 2% a year, something like that. But we wouldn't just dump the property, and we wouldn't necessarily pay for a refinance if we didn't think the value was going to come out right. So we would just batten down the hatches, keep collecting rent, keep paying down our mortgage, keep improving the property, executing our value add strategy, trying to make it a more desirable place to live, and trying to increase rents through a recession as well, which you can do by renovating units and doing physical improvements to the property, making a better place to live. People still need a roof over their head, right? So we have a solid commodity. People still need to pay their rent in a recession. So even if rents aren't growing, even if property values aren't growing, property values drop, there's some big recession. Well, I think apartment buildings is one of the best places to head for shelter. Are you going to lose out a little bit on the short term by not being able to refinance as quickly? Yes, absolutely. Instead of refinancing in 3 years and getting half your investment back in 3 years, as we're accomplishing now, you'd probably be looking at about 5 to 8 years, right? Depending on how long it took for the market to cycle. The good news is generally when markets cycle down, they cycle back up pretty aggressively as well. So, you tend to see a growth period after that, which would allow us to then complete our cash out refinance. So again, maybe instead of getting half your investment back in a 3 or 4 year period, like we're seeing in a bull market right now, it could take 6 to 8 years to get to that refinance point where you're getting half of your investment back. Now, at that refinance, okay, you can get back your initial investment, exit the investment, keep the funds from the refinance, keep the funds earned from cash flow, and sell your ownership of the LLC. Or you can choose to say invest in the LLC, continue to earn quarterly cash flow, continue to get a large lump sum every 3 to 4 years as we refinance the property. And that's what most of our investors opt to do. About 9 out of 10 of our investors opt to stay invested long-term in the building. So that's it. We buy for a good price, we renovate it, we force equity into the building, we release for top dollar, we lower our expenses and find more ways to make income on the property and more amenities to make it more desirable, attract the right tenants. And then we refinance at the right time. If the market's down, we're going to pause that refinance, wait for that market to come back, But like I said, there's a lot of upward pressure on housing in New Jersey right now.
Okay. So you mentioned, so what's the minimum I need to invest with you, and do I need to be an accredited investor or not?
So the minimum investment is $30,000.
Okay.
And you do not have to be an accredited investor. You can also be a sophisticated investor. So another thing people like about us, first of all, we have our own in-house property management company. Secondly, we focus on New Jersey, which most syndications don't bother with because of the red tape. But thirdly, we accept non-accredited, sophisticated investors. That means you have some experience investing in real estate. Maybe you own a home or you've bought some income properties before. You don't need to live on the returns of the investment. You have ample income through a job or other investments, and you also are not investing your final income amount, investment dollars. We only want to take about half of your investment capital at most. So if you meet that category, some experience, excess income, excess savings, don't live on the returns, then you're a sophisticated investor and you should qualify to invest with us. Okay. There is a process. Not everyone qualifies. Even if you're accepted, it doesn't mean there's going to be room for you in the next opportunity. It's first come, first serve fund. However, the process is we first set up a discovery call. And you can do that at peoplescapitalgroup.com. You can click a button that says qualify to invest, and we'll reach out to you then to schedule that discovery call. So once we do that, I'll answer all your questions about how to invest, the risks within, our track record, our vision long-term, and make sure you're qualified and make sure our investment goals align, and talk about your investment goals as well. It's about a 15 to 30-minute call. Then granted you're qualified, we'll have you fill out a basic qualification form, and then you're in the system as a qualified investor. You can actually review opportunities, digest them, watch the webinar, look at the numbers, look at the offering memorandum, all the due diligence on the property as well that we complete, and then decide if it's a good fit for your investment goals. All right. And it's pretty easy to invest. All the paperwork is done right online. You can click right through our process on Syndication Pro, basically sign up on the investment right there once you're qualified. But they do fill up very quickly because we tend to perform on our investments. We under promise and over deliver. We set the bar at an attainable level, and we tend to do about 30 to 50% greater than our initial targets. So our current investor pool is very satisfied. So they tend to reinvest very aggressively. And these opportunities get filled up very quickly, because the hardest part is actually finding a good opportunity. So you want to go to peoplescapitalgroup.com, fill out that form to get qualified, to get on that list. That's the process.
Well, it sounds like to me that the reason your folks continue to invest and reinvest is because of the approach you have. Is you find out what their needs are, not force your needs on them, and make sure it's a fit. And that's similar to what we do at the very beginning. Is let's find out about these owners. What do they want out of this? What's how do they, what's their long-term goals? And when goals are aligned, it seems like business is the business results are a lot better.
Oh yeah, absolutely, absolutely. And I'll talk to people sometimes on the discovery call, and they'll say, listen, I need my money back in 1 year and I want to double it. I'll say, you're talking to the wrong guy. I don't know what to tell you. Look into crypto, buy some Bitcoin, see where that goes.
Right.
We're a long-term investment. We're tried and true. We take established assets and make them better. Mismanaged apartment buildings in a high demand market. It's a brick and mortar asset. It's just improved management, physical renovations. But we try to take as much risk out of it as possible, right? We're not doing ground up construction, although we do have some projects going on like that. And that could be advantageous also, but there's more risk to that. We try to we're not adding a level of these apartment buildings or getting variances or architectural drawings done or things like that. It's really more very limited renovations so we can quickly release the property, the units for top dollar. But yeah, no, your goals have to align. We have to put our best foot forward with our tenants. A happy tenant equals a happy investor. That too. And that's part of kind of offering these solutions to your tenants. You give hey, listen, sign up with the Verizon here. You'll get 15% off. It's a little promotion our building's doing. Oh, by the way, we're affiliated with them. People, your tenants actually don't mind that stuff. They might actually appreciate it. They're like, oh, okay, cool. I was going to pay for Wi-Fi anyway. So your service there is pretty interesting. How you can, give your tenants another amenity. Maybe a promotion on Wi-Fi or something like that, and make that revenue stream on your end as well as the landlord. It can kind of really be a win-win, and that's what business is all about, you know?
Yeah, absolutely. Oh, you touched on it. If the residents are happy and they're referring other people to come in there, I mean, just the rest of it all falls into place.
Yes, exactly. Good tenants attract good tenants. They tend to tell their friends about it. You know, we often encourage that. And then, yeah, good tenants pay the rent on time. They
Yeah.
don't beat up on the building. They don't get the cops called on them, you know, and so it's definitely a good cycle there to make a good environment. That's what repositioning a building is, right? It's taking
Yeah.
a building that's not really you can walk into an apartment building, like apartment complex, and kind of get a feeling pretty quickly, you know.
Right.
You're either comfortable there or you're not comfortable, right? And we've probably been to both types of buildings. So you want to
Yeah.
make an environment that's safe, that's clean, that smells nice. You know, there's not like a bunch of, trouble going on and cops showing up and stuff, drug dealers, you know. So we come in, we fix those problems, we make it a family-friendly environment, we feel safe living, and we bought some pretty questionable, properties and questionable locations. And, our investors will be like, you guys sure you got this one? Be like, and
Yeah.
those are the most profitable investments we've ever had. The ones where people say, well, that's kind of a rough spot, or, they've been in the building, there's some troubled tenants there. What are you going to do? So those are our best deals. Those are when there's the most amount of profit to be split up at the end of the day. When we really, because you buy it for the best price too.
Right. Yeah. You turn it from an apartment to a home, right? When
Right.
residents feel like it's their home and not just an apartment, then you've been successful.
Yeah, 100%.
Yeah.
Absolutely.
Awesome, man. Great stuff, Aaron. I learned a lot. I appreciate it.
Yes, thank you. Thank you so much for coming on, Kevin. So how can people learn more about you and get in touch with you?
Well, I tried to strategically place my banner behind me here. So multifamilyutilitysolutions.com, or Kevin at, if you want to just email me as well. And then my phone number is 248-930-4768. So love to do intro calls, love to find out about people's portfolios and their investment goals, and, see if it's see if it's a good fit.
Absolutely. You know what, Kevin, why don't you put that in the chat, okay, for our viewers to check out here. I'm also going to put in the chat a website here that our viewers can click on. So the link I just put in the chat to everyone is a link to our Syndication Pro website. That's where you can click on it, fill out a basic form, and then get access to our upcoming offering. Just some basic pictures and numbers to understand what that looks like and what that investment experience would be like. It's going to prompt you to also schedule a call with me, Aaron Fragnito. That's going to be a discovery call, which I talked about earlier in this presentation, that allows you to get to learn more about how we help people invest in real estate, and also see what your investment goals are and make sure they're a fit for our investment goals as well. And then once we complete that discovery call, ideally you'll be qualified to invest with us, either as a sophisticated or accredited investor, and you can review the entire offering and much more information on the property and the due diligence, and decide if it's a fit. So that's the first step, is clicking that link I put in the chat there to get qualified, to learn more about our investment opportunities. We only work with qualified investors, and we're about to put out a private offering next week. So once this offering goes out, my schedule gets very busy with discovery calls and everything else. Also, our existing investor base will want to connect with me as well on calls. So there is a process there. It gets very busy and the spots fill up quickly. So instead of waiting till you might get that email or notification of the offering being released and then getting in the back of the line for the discovery call, you're better off clicking the link now and signing up, getting a basic understanding of the offering, scheduling that discovery call today. So hopefully we can connect, learn more about your investment goals, see if it's a fit with ours here at People's Capital Group. And you can learn more about us at peoplescapitalgroup.com. We have weekly podcasts, weekly blog, weekly webinars as well, educational videos, and that's all at peoplescapitalgroup.com. You can learn more about us. And my name is Aaron Fragnito as well. Thank you, Kevin, for coming on. Any parting words for the listeners?
No, I enjoyed it, Aaron. I really did. This has been fun. Let's do it again sometime, right?
Awesome. Excellent stuff. All right, Kevin. Well, I'll leave this up for a little bit here for our guests, but I'm going to check off here. And it was a great pleasure here going live with you on Facebook. Stop our live stream here. Enjoy your
Yeah.
day.
And let me just thank everybody who hung with us and attended. We appreciate you, investing your time in listening to us.
Oh, absolutely. Yeah, we had a nice turnout here. We also went live there. We'll see who checked in there. But yeah, it was great experience here. Had a good turnout. And yeah, Kevin, absolutely. We'll have to reconnect and maybe do this again in another season or two. All right.
Sounds great.
Thanks a lot. Have a good day, my friend.
Everybody have a great day.
Thank you.